Welcome to RISKSA TV. We're here at the second day of the PSG conference, and we're speaking to Anet Ahern, who's the CEO of PSG Asset Management. Welcome, Anet.
Thank you.
Firstly, there are many challenges that the industry is facing. You mentioned conglomeration of financial services as one. Can you explain this to us a little bit, and why is it such a concern for you?
I think what's happening at the moment is that companies are getting involved in the whole value chain. In other words, they do everything from the advice right down to the production of the products and the platforms in between. And what a lot of those companies are starting to do is to limit the choice available to the investors. Now, investors shouldn't have limitless choice, because I think that's also irresponsible. But I think that for some of the very small asset managers, I think that's a bit of a concern, because it becomes harder to get onto the platform. We're in the fortunate position that we have our own platform, so we have an open architecture platform, and it's actually quite an open one. It hasn't gone as limited as some of the other platforms. And secondly, we have engaged with both advisors and the platforms to get representation, because our size makes us big enough. But I think there is a danger that you get the same funds on all the different platforms, and I think that's something that would ultimately not be good for the investors.
Absolutely. Speaking about the size of asset managers, what are the advantages to being smaller?
Okay, I think we need to define the term small, because if you're too tiny, I think it becomes harder to get bigger, as I've mentioned before, because of the structure of the industry changing. So if you're our size, which is about 16 billion, a couple of clear advantages. The one is you've got a bigger investment universe. You can invest in mid and small cap companies when they offer value, or you can invest in large companies when they offer value. In our case, we also invest internationally, so we have a really huge investment universe, which is simply not the case when you're a very large asset manager. The second thing is that when you do execute on your choices of investments, you have less of an impact on the market because you're smaller. So in one of our funds, we already own 0.25% of Sainsbury's, which is the third largest food retailer in the UK. And I mean, we're not even that big. So you can imagine a larger asset manager, by the time you actually end up buying the position you want to buy, you've probably moved the price already. So that's a huge advantage to us. And the third one is the dexterity which you have with which you can reposition your portfolio. But I think it's about much more than size. It's also about remaining focused and keeping the investment decision-making process simple and flat. So there are large asset managers who've done this quite successfully, and that's because they've managed the complexities that come along with becoming larger in a clever way. It's also about not having too many products. So it's not just about size, but we definitely think it is an advantage that we're going to have for some time.
Okay. There's so much information available. I think there are a lot of people who are thinking that they can just, do things on their own. What is the value of having an advisor?
I think there are quite a few areas in which the advisor can add value, not the least of it being making the investment more tax efficient. And I think what a lot of people do when they look at their wealth is they look at their investment portfolio and they forget that a lot of them are still got a lot of earning potential, and they end up taking too little risk with the money that can work for them. Because if you take a present value of your earnings until retirement and you compare it to what you've set aside, actually that pot of money has to work really hard for you. So I think that's one of the things an advisor can take a holistic view of all of the investments. I think there's also a portion of your investments that you need to build some kind of guarantee in to hedge yourself against outliving your money, because people are living longer and longer. So that's hard to do on your own. You need someone who can really dissect the guarantee that is built into the product, and you can dissect the fees you're paying for it and actually disclose that to you. So I think that's the second thing. Tax I mentioned, and then I think it's also important that when you retire, that someone helps you do a responsible drawdown on your money. It's very hard for someone who has not studied the CFP or who's not an advisor to calculate exactly how much of their money they can live on every month, and that's why so many people end up running out. So I really think there's a huge amount of value that that advisors can still add.
Very important role indeed. Thank you very much for joining us.
Pleasure.
For RISKSA TV, I'm Christy van der Merwe.